So moving on to fixed income. Now this is the premise that I want to provide for you today, is I'm taking off a fund manager hat and putting on the advisor hat and sitting in your position as to what value you are providing your clients in fixed income as we move into the next phase of a US rate hike cycle, no matter how steady that cycle may be. And I'm going to talk about how our fund exploits inefficiencies in the market would allow us to give you a yield that you can justify to your clients net of fees. So as you build your diversified portfolio of cash, term deposits, international property, Australian property, international fixed income and international equities, and our home bias of Australian equities, there's a missing component. And the missing component is there's a number of reasons why this missing component is still missing today. We're at the end of a 30-year bond market rally, and as rates start to rise, we're scared that those returns will reverse. We all remember the good old days of just after the GFC, and traditional investment-grade bond funds would give you 8s and 9s solely because the rates kept crashing down. But now as it reverses, how are fund managers and institutions going to financially engineer their way out of collapsing capital values on bonds? So all we want to consider for you today is global credit. Think about the last 5 to 6 years that you have ever walked into a funds management presentation talking about fixed income, and the headline was, how do we generate sustainable long-term yield for your clients? They show you the performance returns, and then you leave and you go back to your office, and then you sit down and do some calculations and go, wait, hang on a minute. If I strip out my advice fee, which in Australia averages about 88 points including GST, and platform fees for your average client are about 55 basis points net of GST, what do each of the underlying asset classes by which you invest in give you net of that fee? Think about it for a minute. Anything that's highlighted in red here is less than what you achieve for a 12-month term deposit rate today at a leading institution of around 2.5%. How do you currently communicate that to your client, saying, I'm invested for you, say, for example, in Australian fixed income. I'm giving you a return less than term deposits, but I'm giving you all that bonus volatility that you really wanted. Or international. Or cash. Or term deposits. What is the value of term deposits for your clients? What we present to you is a 7.3% gross yield before fees, netting out at 5.87. That is true, real yield for your clients. Now, some of you might then come to me, and the argument that has come to me post this is, Jonathan, I don't have to worry because I don't buy traditional Australian fixed income for my clients. I buy hybrids. And I'm going to show you what hybrids sit in that capital structure as you see here. We only ever focus to protect your clients is senior unsecured debt. This is defined by the capital structure of how they're issued out to the market. Senior unsecured debt versus hybrids. Looking at a masthead of a brand does not reflect the capital security your clients are going to get in a hybrid investment. Yet because of the face yield of, say, 275 or 290 points above the 90-day bank bill swap rate, it looks, on face value alone, attractive to your clients. We did a bit of research and looked at the longest hybrid in history we could find, which was the NABHA, otherwise known as the National Income Notes. These were issued in 1999 at a face value of $100, as you can see from this Bloomberg snapshot chart. And as of today, they trade at $77 a piece. If we equate this to your client at the end of the day, they have achieved a return of 5.2% per annum, including the yield, with 8.7% volatility. But Jonathan, no, let's look at a shorter time period. I mean, this includes GFC and includes all that extra volatility. Sure. Let's remap that figure back to when we launched our fund till now. So 6 years, exactly 6 years. And that has generated you a 5.5% total return with 8.1% volatility. We present to you an 11% total return strategy with 5.4% volatility. Now, there is no doubt in my mind that any of you that have ever been presented with funds with a Sharpe ratio of greater than 2, your ears start to prick up and your eyes start to open, because there are very little funds left in the industry that have Sharpe ratios of greater than 2 times. This is our dedicated team to find value for you in the fixed income space, led by Gordon Ip, who's the head of fixed income with over 22 years looking at Asian debt. We have, and this is going to be the oxymoron statement of the day for you, ladies and gentlemen, Chinese property companies form the basis and most secure set of investments we can give you in the Chinese bond space. The reason for that is when you buy a bond, you have a binary outcome, don't you? The binary outcomes, you either get your money back or you don't. So that's why 40% of our portfolio provides that baseline for your clients to generate the yield you want net of fees. We have in the team Elaine, who actually dedicates her time solely looking at China property bonds. They have won numerous awards. Out of 500 individual analysts, economists, strategists, Gordon is ranked number 4 in the world. The ironic part about them and their relationship with us is that ours was the first fund that was launched. It now sits at $32.5 million. And a lot of the advisors, and some of you that are in the room have supported this fund, have asked me, Jonathan, why is the fund so small? It's so good. And we go, we can't answer that question. Because there is, unfortunately, psychologically misplaced risk as to where a lot of advisors and your underlying clients think where risk actually lies. And we've had feedback from now bank research individuals that have said, I don't understand why this fund why people think it's high risk. It's not. There's no leverage. It's not a hedge fund. It's just buying bonds that have got a high yield. Value Partners launched their Greater China High Yield Fund in 2012 after us, and now is almost $4 billion US, making them the largest Asian high yield manager. Now, why that is important, I'm going to come back to a bit later. And it also surrounds around liquidity and how you actually buy bonds. Because bonds are generally not traded on an exchange, ladies and gentlemen. They are traded OTC, over the counter. And I'll come back to that a bit later. This is how, single-handedly, we get you the returns that you want. We believe that names such as Moody's, Standard & Poor's, and Fitch provide an FYI to us as to what they think a rating of a place is, country or corporate. We believe they have an antiquated system of how they rank bonds and how they rank risk. And the best example we can show you is, this is the JASI index, and this is the JASI index for the entire month of May. This is the performance of the JASI index, which is the JP Morgan Asia Credit Index for the month of May. Now, does anyone recall what happened in May with Moody? We've already written at the top of the screen. They downgraded the country. If I was to ask you, ladies and gentlemen, think about which day in the month of May they downgraded China, I don't think you can guess. One-day blip. How serious do you think investors are really taking large research house ratings when it comes to risk of bonds? You have to remember that China started deleveraging 2 years ago, which I'm going to show you a bit later on, and 2 years later they downgrade China. It seems a little bit late as to how they see China going forward. By not caring what the research rating is, allows us to find you the best ideas to get you the best yield for your clients. Our investment process, or our universe, are made up of about 1,000 bonds, listed on this left-hand side here, which make up around 400 different issuers in the market. We then look at every bond in that universe that can generate at least a 6% yield, and then strike everything else out. So that breaks us down to about 400 to 500 bonds over 200 to 300 issuers. And finally, that blend breaks down to 250 to 300 individual bonds for us to do underlying credit analysis on. The underlying credit analysis gets to the point where we hire private investigators to visit logistics companies that check whether or not they're actually lying to us. So we had a logistics company that said, oh, we've got X number of trucks leaving our ports per day. So we actually put private investigators at each of their port operations with one of those click button things and says 1, 2, 3, 4. And we found they were lying to us. So we didn't invest. And then the bond never paid back. That's the type of research we do to find you the returns that you want. So the fund, 6 years old now, $32 million, charges a flat 98 basis point fee. So this is the only strategy we have that doesn't have a performance fee. So those of you, I know there's a number of advisors that are more sensitive to any funds that pay performance fees. This is our strategy that does not. We pay quarterly distributions out to your clients of at least 150 points per quarter, and we've never, ever missed a beat since its inception 6 years ago. And taking into account, there's something that none of you read about, is that the last 6 years, there have been 2 emerging market debt crises, and we come out of that completely fine. We're giving you a 6% annual payout, at least to your clients. We're the best performing credit fund in Australia for the last 3 and 5 year period, and we offer better diversification to your clients who already have enough low yielding developed market bonds. This is the latest financial standard chart that came out at the beginning of September and collates all the data of every single credit fund in the country, ranked 1 to 10 on a 3-year basis. We are the #1 credit fund for 3 years and 5 years, and ranked #4 over a 12-month period. And that's why everyone is asking us, how is your fund only $30-odd million? We'd like to ask the same question. The portfolio strategy is made up of mostly high-yield bonds, and we prefer secondary bonds rather than primary issuance because secondary bonds have a track record of the level of support the market is giving it. So people that wanted to buy it has already gotten and holding it. People that want to get out after issuance has already gotten out. So we like secondary issuance. We do a little bit of new issues trading when there's some arbitrage we can play into the market. We buy a bit of convertibles, and that's 93 to 94% of the portfolio. We then activate active Australian dollar hedging strategies to reduce overall volatility because the Australian dollar is very simple to value. It is highly correlated to risk assets globally. So when we have a Delta 1 event whereby the whole market tanks, Australian dollar will naturally come off. And we use that strategy to reduce the vol for your clients. Then on the 6 to 7% that's left in the portfolio, we call that special situations, event-driven opportunities. And putting it all together, lower rated credits is our specialty, under-researched credits, and event-driven. Remember, ladies and gentlemen, there is no such thing as bad credit, only a bad price to pay for bad credit. Gordon has always said, if the price is low enough, I'm happy to own crap. The special situations that we buy into, here's a very good example. This is a China property developer called Futureland, which I know sounds like a theme park. But in actual fact, what happened was one of their senior officials, well, senior management, was apprehended by the government and investigated by the government. Now, I'll leave it at that. You make your own conclusions what happened next. But its bond collapsed in price. Now, you have to remember, this bond before that official was investigated was $110, and then at a crisis point, it got down to 98. We did our due diligence and went, there's no problem. So we bought it. Originally, this bond was supposed to mature in August 2019, but they ended up calling it, which is something that we rarely see in Australia, right? As in issuers calling back their bonds early. They called it in March of 2017 this year because they wanted to save on interest cost. So we started buying at 98 and we started selling at about 105, 106. And we had a little bit left on the table when they called it and we got back $100. So we made all that capital gain in such a short period and all the coupon. Our largest holding today is a company called Gaga Tanjol, which is an Indonesian tire maker. And they are going through a process of restructuring their bonds because everyone's concerned about whether or not they'd be able to finance their bonds that expires in 2018. So we've helped them restructure it by borrowing half from the bank. We buy the other half. And we've started buying in their bond at $92. It's closed out $100. We got back $100, and we're getting into the new issuance that expires in 2022. Because of our sheer scale and size, the brokers give us whatever allocation we want. And across all their $4 billion, we picked up about 20% of that entire issuance, which is about $60 million US. These are the type of opportunities that make up the 6 to 7% of the portfolio so that we don't add too much volatility to your clients, but we give you that extra bit of alpha for what you want. Here's the performance of the fund at 11%, as we noted before, with a volatility of 5.4%. Cash yield of the fund is 7.3%. And if you do a line of best fit, ladies and gentlemen, that line's pretty straight for 6 years. For 6 years. Okay. There is duration on the portfolio at 3.1, but what I want to stress is you cannot look at this fund from a duration perspective. It's irrelevant. 99% of the bonds are fixed rate bonds. There's so much spread and fat in the margin that we're not concerned about US rate hikes. And I'm going to show you what happens to Asian bonds when there is a US rate hike. The only risk you need to be concerned about in this fund is credit risk. And that means we haven't done our research properly, which means the binary outcome ends up in the zero category where your investors aren't getting any money back. There has not been a single bond in this portfolio that we have ever invested in where it did not restructure when we did not expect it to restructure. When we look at the geographical exposure of the fund, China or Hong Kong makes the largest part of it. Indonesia is the next one because there's a lack of supply, good yield, and good fundamentals. So lack of supply means that the demand is incredibly high. Next is Russia. And just to put all your minds at ease, they're all Russian banks, which is every day we invest into those. Then we've got Middle East, India, Japan, Mongolia. Now, the 6 to 7% special situations in 2015 was Russia at the height of the sanctions. In 2016, it was Mongolia because they were finally bailed out by the IMF, both events that we expected to occur. We almost got into Qatar. So for those of you that I saw a couple of months ago, we were considering Qatar as an investment at the height of the sanctions. We missed that one. All the supernormal returns have already left. But we're looking at another sector, which I'll come back to, which really hits home in Australia. Russian banks we bought, which is most of that 10% you see there. We were buying them at 16% yield. They're now down to 4%. Right? So that's the special situations that I'm talking about here for your clients. And this credit ratings thing, we put it there just for fun. It doesn't really relate to how we invest, and it's completely irrelevant. This is our distribution track record for your clients. In the last 12 months, we've paid 10.6% out to your clients, cash in hand. When we see the yields of the underlying securities very strong, we'll make a call partway through the year to increase it from 1.5 to 2 or 2.5, depending how we see the market, because as you can see at the year end that just passed, it was 5.1%. Liquidity. Going back to the point of us being the largest Asian high yield manager in the world means that we're the largest client for most brokers in the world for Asian debt. So when we look at the liquidity profile, we get the best prices and can get out of the market as fast as we like. So in one trading day, these are two different scenarios by which we run liquidity on the portfolio. We can get out 99% on day one, and within 5 days, we'll get out everything in the portfolio. So looking at the market review and how we see this going forward for your investors, originally our fund was about 60% property. We're now down to 40%. Do you know why? Because originally these property bonds in 2015 were giving us 7s and 8s in face yield. They've come all the way back down to 3 and 4, which makes them unattractive. We can't make enough money out of it. Hence, we're out. So we're now 40% property, but we still need to hold a lot of property because that's the stabilizer for the portfolio. The JASI is almost 60% property. Housing inventory has fallen off. Instead of 36 months to drop off, it's now down to about 24 months to clear inventory in lower tier cities. It's much less in higher tier cities. We're talking about tier 3 or tier 4 cities. Those cities in China which are tiny, that have populations of about 2 million plus. And this is how we generate alpha. Remember all the concerns we saw in China about 2 years ago? Well, this chart maps out those last 2 years. If we look at those investment grade credits, that's your yield. Then we start looking at higher rated high yield. Then we start looking at lower rated high yield, and that's the yield. 2 years ago, we could buy bonds with a 30% yield. Obviously, a very tiny portion of our portfolio. But that has come right off, and now it's down to 10% because there's no risk in China. Very, very little risk in China, and the market respects this. Commodities. This is the special situation we're currently looking at. Why? Because as the commodity prices came off, credits within the resource company space collapsed. So 3-4 months ago, we bought Fortescue metal bonds for the portfolio at a 16% yield. If that was presented to you, is that interesting? Fortescue is a household name. Do you think its ability to collapse is particularly high? We sold the bond at a 3% yield. That's how much cap gains we made on that bond. Because of the resource prices coming off, all these resource companies' credits have been significantly depressed to distressed levels. And while the commodity prices recovered, those credits haven't moved. The two birds with one stone theory with regards to this theme around commodities is that if the world is going well, inflation comes back, resource prices go up, this also provides us with an inflation hedge to the portfolio. So watch this space as we're about to enter it harder than ever in that 6 to 7% of the portfolio to give your clients some alpha. Asian credits are only bought by Asians. Oxymoron. But the number of issuers and the market value of those bonds continue to rise. And that's what you're seeing right here. Our universe is huge. And we're only a tiny, tiny part of it, even right now. The deleveraging that I talked about, as I said, happened 2 years ago. Corporates now in the last quarter was down 22%. New bank loans to corporates are down. The safety and the margin of safety we have to invest in EMD now is higher than ever. And so we're giving you a conservative 7-ish% yield for your clients with very minimal volatility so that your clients can enjoy real yield as opposed to net after fee low yield. The final question, ladies and gentlemen, is what happens in a US Fed rate hike? In the last full cycle where we saw rates rise in 2003, it was steady, but it was pretty fast. Asian dollar bonds went up. So we've already done the performance now in a low, non-rate hike environment. The thesis is simple. World economy does well, and let's face it, the US Federal Reserve is not the Reserve Bank of America, it is the Reserve Bank of the world. If the world is going well, they will raise rates. If raise rates, corporate earnings must be higher. Corporate earnings are higher means capital security for your clients invested in bonds is higher. Hot money goes into emerging markets rally, and here's your green line. That will repeat. And this is why this is counter-cyclical to what you believe will occur in developed market bonds as rate rises start steadily moving up. And we're still at pretty much the bottom of the cycle. So answering the three key questions for fixed income, the inefficiency that we're playing on is that global rating agencies provide little value in sorting through opportunities within credit securities, especially for EMD. Developed market investors rarely invest in emerging market credit except for Indonesia because they perceive there is lower political risk. And in turn, emerging market credit is overlooked and mispriced. So how does our process exploit the opportunity? Well, we spend time doing our underlying credit research. And there's no such thing as bad credit, only bad price. And why do we expect that it will continue to exist in the future? Because credit funds continue to use rating agencies. And as long as they keep using rating agencies, we're going to keep delivering alpha. It's a really simple message to your clients. So the so what for fixed income is consider what running yield you're achieving for your clients, for your existing fixed income investments, and how they actually stack up on a pre and post fee basis. Not pre and post on investment management fees, but pre and post against your fee and the platform fee that your client is paying. Remember that fund managers can capture inefficiencies in the market in which they operate to ensure that you de-risk your clients' portfolios. So again, counterintuitively, if you consider something like our fund, you actually de-risk the yield portion of your client's portfolio. And thirdly, please do not suffer from psychologically misplaced risk in both the equities mindset as well as the fixed income mindset when you build your client portfolios and potentially consider us to be a part of that. So that comes to the end